In this video, we're going to look at the good question of, is it riskier to day trade cryptocurrencies or stocks, Forex, commodities, and that kind of thing? Stay tuned. Hey traders, a very warm welcome to you. Okay, so great question here. Is it actually riskier to day trade the traditional things that we would day trade, you and I as traders, Forex, stocks, commodities, bonds, indices, that kind of thing, or cryptocurrencies? I'm going to put those all into one category and let's compare it to cryptocurrencies and let's see which we think is the riskier to trade. So the first thing that we've got to look at really is the volatility of each of them. Now, do you know what? Volatility is useful for traders. We can have a situation where, markets can be too volatile, but don't forget, you can reduce the risk and dampen down that volatility just by reducing your position size. If something is very, very volatile, then sure, you reduce your position size right down. As long as it's not volatile enough that the minimum position size isn't too big for you, you're good. And we do have situations where Forex, stocks, particularly some stocks, some indices, have big news coming out of them, can be extremely volatile. So to compare cryptocurrencies to the traditional kind of trading instruments is fair enough. And we know that cryptocurrencies can be very, very volatile, but is that a reason not to trade them? In my opinion, no. I think you can dampen down that volatility as long as you can get your position size down. And if you're trading directly on exchange with Bitcoin or with Ethereum, whatever it is, you can obviously trade a very small percentage of a whole coin. So you can kind of do that if you're going to do it that way. So volatility, I don't think is a big issue with these two things. You've got to respect the fact that cryptos are volatile. And one thing perhaps we could put on here, but I would probably put it in number two really, is the instrument risk. So what do I mean by that? So if you're trading a stock like Apple, it's unlikely to suddenly go down 20%. It could do, there's things that have happened before and news is breaking out. You've got to be prepared for this kind of stuff, which is why we have risk management strategies in place, more likely to stop losses in the market, to stop that happening. But with some of these cryptocurrencies, we do have scenarios where news is really seriously driving them. So you've got to be aware that if you're day trading them specifically, and most people who are day trading are going to be using a little bit more size than they would if they're swing trading, because they're going to be more aggressive onto the position, going to look to take smaller moves. That's generally what people are doing when they're day trading. So you've got to be aware of the instrument you're trading and where the risk will come from. Now, obviously, there's a lot of event risk in stocks and Forex and commodities, etc., from scheduled news events like earnings, like oil inventories, non-farm payrolls for indices, that kind of stuff. And you can be aware of that. And sometimes the news drives a lot of these things as well. But cryptocurrencies generally are driven by news. If a government comes out and says something, or if someone says this and says that, it can push the price significantly one way or the other. Now, if you've got a stop in place, you might well end up running through that stop. You might not even be able to put a stop in with the exchange you're trading. They might even not honor that kind of stop, and we'll get to that in a second, counterparty risk. But you've got to be aware that the sudden price swings in cryptocurrencies tend to be way more aggressive than these kind of things. You can plan for Forex stock risk, but I think crypto, you've got to be aware there's a lot more inherent underlying risk of extreme moves just based on news. So that's something to be aware of. Number three is execution risk. Now, if you're trading directly on a Bitcoin exchange and you're buying actual Bitcoin or you're buying actual Ethereum and you're doing that, you've got to understand that you probably aren't, you definitely aren't going to get the same kind of fill in terms of speed, in terms of quality, in terms of knowing where you are when you compare it to something like a stock when you go straight to the NASDAQ, or Forex when you're going to an over-the-counter dealer, or any of these kind of other instruments. Crypto, if you're doing that, you're going to go directly to the exchange. It might take you a long time to get filled. It might be high cost to get filled. You don't know if the exchange is going to go down. We've had lots of instances where exchanges have gone down. Yes, NYSE does go down from time to time. Your broker does go down, but it's far less frequent. So you've got to accept there's a serious execution risk when you're trading crypto. And in a minute, we'll talk about how we can reduce that. But for now, just be aware that you're not trading something that a lot of other people are trading. Sure, it's busy, sure, it's active, but it's nowhere near the level of Forex and stocks. So what have we got next? Counterparty risk. This is basically if you're holding your funds in an exchange or however you're doing it, and it's not quite as secure as it would be if you were holding it in a verified dealer or a verified broker that's backed that's authorized, that's regulated, that's got all the credentials you need. You'll know your money's protected. You know they're doing the right thing. Someone's not going to run off with it. If they get hacked or something happens, you're probably going to be okay as long as you've got under the limit that the government will bail you out with. So you've got to be cautious. Your counterparty risk is relatively high when you're trading cryptos. We can reduce that in a second. There's a couple of things in a minute that I want to talk about with that. And profitability potential, this is the big one. Obviously, we want to make as much money as possible for little risk as possible. And we might just want to go with the most volatile product. Now, do we look at cryptos and say, well, there's a different level of participation and the players who are involved in it are far easier to predict? That's potentially it. We've got a lot of retail in there, a lot of gamblers in there, a lot of kind of people looking for just pure speculators, so we know their motivation. Whereas if we're trading a stock like Apple, Tesla, what have you, maybe the motivation is for a long-term profitability, and perhaps, you know, they're spreading their order out over the whole day or the whole month, the whole whatever it may be. Perhaps there's different type of players in there. Does that make it easier to predict? I guess it depends on the strategy you're using. You're using kind of momentum strategy, mean reversion. How are you playing it? So just because something's volatile doesn't necessarily mean it's got more potential to be profitable. I suspect if you've got something that's really has the potential to, you know, blast off into the stratosphere, which these cryptos maybe do, some stocks do, but not as much, then you have got the potential of perhaps fine-tuning your entry on a short-term basis and tucking some away for a longer term. Now, going back to these 2 points here, execution risk and counterparty risk, one way to combat this, rather than you trading directly with a Bitcoin exchange or Ethereum on an exchange, you could trade with a broker that allows you to trade Bitcoin and Ethereum, and it mirrors the price. So something like Intertrader, which is regulated, which is all the credentials that you need, your money's protected, you don't have any execution risk. Sure, I'm sure if you try to do massive size, they're going to say, hang on, let's just take some time to fill that order for you, as they would if you were doing anything. But if you're trading sort of regular size, you're going to be able to get it in and out relatively easily. You're going to have to be able to put stops in, limits in. You're going to be able to trade it in almost exactly the same way as you would be if you were trading Forex on the same platform. And the same with the counterparty risk. You know, these guys being regulated, you know that you're protected. If they go down, then you're protected. If there's a problem, then you know there is a backing behind it. They're not just going to disappear into the sunset with your money. So that's something to consider, you know, some way of getting exposure to those crypto markets by trading through someone like that. Anyway, those are my thoughts on, is it riskier to day trade? I think it's a mixed bag. The summary is, I would say that it's probably riskier to trade crypto if you're going directly to the exchange, but if you're doing it through some kind of dealer or your broker like Intertrader, for example, then it becomes very similar in terms of trading stocks, Forex, commodities, or whatever else you want to trade. As long as you allow for the volatility and all those other kind of stuff that come from the actual inherent market movements of the product you're trading. All right, guys, take care. See you in the next one. Keep your risk managed, whichever one you're trading. Bye-bye.